Hey everyone, and welcome to the podcast. I'm your host, Daniel.
And I'm Nala, excited to be here and dive deep into the world of crypto pricing.
Today, we're tackling a big question. What actually drives the price of cryptocurrencies? It's a wild ride, and understanding the factors at play can really give you an edge.
Exactly. Crypto prices are known for their volatility. We'll be exploring several key influencers, drawing from expert insights and research.
Let's start with the basics. Supply and demand. It's economics 101, but super relevant here. Nala, can you break down how this works in the crypto world?
Sure. Like any asset, when supply exceeds demand, prices fall, and vice versa. But with crypto, the supply side is often predetermined at the start, something called tokenomics. This includes the total supply, how it's distributed, and even burn protocols, which can reduce the supply.
So scarcity can be built in. What about the demand side?
Demand is trickier. Short-term demand is influenced by a bunch of things, but long-term demand hinges on real-world utility. Does the crypto actually do something useful? Successful projects solve problems, which drives demand and therefore price.
Makes sense. Utility is king. Okay, next up, market sentiment. This one feels a bit more psychological. How does the overall mood affect crypto prices?
Oh, sentiment is huge. Crypto is very speculative. During bull markets, you get FOMO, fear of missing out, and prices skyrocket. But in bear markets, panic selling causes sharp declines.
It's like a self-fulfilling prophecy sometimes. There are tools to measure this, right?
Yep, the Fear and Greed Index is a popular one. It ranges from 0 to 100, indicating fear or greed in the market.
Good to know. Moving on, let's talk about the media. Seems like every other day there's a headline about crypto. How influential is the news cycle?
The media is a double-edged sword. Social media especially has a big impact. Key opinion leaders, or KOLs, can really move the needle, especially for smaller altcoins. Think of Elon Musk and Dogecoin.
Ah, yes, the famous Musk effect. But negative news can be devastating too, right?
Absolutely. A single report can trigger a collapse. The downfall of FTX is a prime example. CoinDesk published a report that led to its rapid collapse.
Okay, so media plays a significant role. What about regulation? That's another big uncertainty hanging over the crypto world.
Regulation is unavoidable, and it definitely causes price swings. Globally, it's been evolving from lax to stringent, and now hopefully towards something more structured. Decisions by the SEC in the US, for example, have a huge impact. The approval of Bitcoin and Ethereum spot ETFs really fueled market optimism.
Those ETF approvals were definitely watershed moments. Now, crypto isn't a monolith. There's tons of competition out there. How does that factor into pricing?
Fierce competition. Projects with better prospects attract more investment, which drives up their prices. Ethereum, for example, faces constant challenges from platforms like Cardano and Solana. Thousands of projects are vying for funding, but most will likely fail.
A battle for survival, essentially. Let's switch gears and talk about production costs. I know this is more relevant for proof-of-work cryptocurrencies like Bitcoin.
Right. There's a positive correlation between Bitcoin's price and its hash rate, which is a measure of mining power. A higher hash rate means more expensive equipment and energy consumption. If the value of mined crypto doesn't cover those costs, miners will simply stop mining.
So it creates a kind of price floor. Finally, let's touch on liquidity. This is all about how easily you can buy or sell a cryptocurrency without affecting its price.
Liquidity is key, especially for smaller cryptocurrencies. Low liquidity can lead to sharp price swings. Listing on more exchanges can enhance liquidity and drive up prices.
Coinbase listings are often seen as a big deal, for example. What about the impact of large holders, the so-called whales?
Whales can definitely cause price drops when they sell off substantial holdings. The crash of Lunacoin was largely attributed to sell-offs by just a few traders.
It really highlights how concentrated some of these holdings are. So those are some of the key microeconomic factors. But what about the bigger picture? How do macroeconomic conditions play a role?
Macro factors are definitely in play, though perhaps less directly than with traditional assets. S&P Global did some interesting research on this.
What were some of their key findings?
Well, they found that bull and bear runs in crypto have coincided with periods of ultra-loose and significant tightening of monetary policy, respectively. Basically, crypto likes easy money.
That makes sense. Risk appetite increases when interest rates are low.
Exactly. They also looked at whether crypto could be a hedge against inflation, which is a common argument. Their conclusion? The track record is too short to prove it definitively.
I've heard that claim, but it's hard to verify with the limited history we have.
They did find that the dollar has generally been inversely correlated with crypto prices. When the dollar is strong, crypto prices tend to decline.
Interesting. So a weaker dollar might be good for crypto.
Potentially. And finally, they found that crypto markets tend to perform strongly during periods of low market volatility and less well during high volatility.
Again, that aligns with the idea of crypto being a risk-on asset. When there's fear in the market, people tend to flock to safer havens.
Precisely. It's important to remember that these are correlations, not causations, and crypto-specific events like the collapse of FTX can override these trends.
Right? And government policies also play a huge role, right? I know China, the US, and the EU have all taken different approaches.
Definitely. China famously banned financial institutions from providing crypto-related services, causing a big price drop in Bitcoin. They're very concerned about capital controls and money laundering.
China's been pretty consistent in its skepticism. What about the US and Europe?
The US has been more focused on administration and agency regulation, with different states taking different approaches. Some are trying to attract crypto businesses, while others are more cautious. Europe, with MiCA, Markets in Crypto Assets, is trying to create a more unified regulatory framework.
So, it's a patchwork of regulations around the world. It's fascinating to see how different governments are grappling with this new technology. Nala, this has been a really insightful deep dive. Thanks for breaking down these complex factors with me.
My pleasure, Daniel. It's a constantly evolving landscape, and hopefully this gives our listeners a better understanding of what moves the crypto market.
Absolutely. Remember, everyone, investing in crypto is risky, so do your own research and only invest what you can afford to lose. Thanks for tuning in, and we'll catch you next time.